Strategic corporate finance planning. In an era where financial markets are increasingly volatile and global competition is fierce, strategic corporate finance planning has become essential for organizations aiming to sustain growth and profitability. This discipline encompasses everything from capital structure decisions to investment strategies that align with long-term business objectives. For accountants and finance professionals, mastering corporate finance principles is crucial to navigating complex financial landscapes. It enables informed decision-making regarding funding sources, risk management, and value creation across various sectors and industries. The core principles of corporate finance. At its foundation, corporate finance revolves around three core pillars: investment decisions, financing choices, and dividend policies. These elements collectively determine how companies allocate resources efficiently while maximizing shareholder wealth. Investment decisions involve selecting projects that yield returns exceeding their costs. This requires thorough analysis using tools such as net present value, NPV, and internal rate of return, IRR. Effective evaluation ensures that only profitable ventures receive company funds. Financing choices pertain to determining optimal capital structures by balancing debt and equity financing options. A well-balanced approach minimizes interest expenses while maintaining financial flexibility during economic downturns. Dividend policies dictate how much profit should be distributed to shareholders versus retained within the organization. Strategic allocation supports reinvestment opportunities without compromising investor satisfaction through consistent payouts. Capital budgeting, the process of evaluating potential investments based on projected cash flows and required rates of return. Accurate forecasting helps avoid costly misallocations of capital. Liquidity management, ensuring sufficient working capital exists to meet day-to-day operational needs. Efficient liquidity control prevents disruptions in production schedules and service delivery timelines. Risk assessment, identifying and mitigating financial risks associated with market fluctuations, credit defaults, and regulatory changes. Proactive measures reduce exposure to unexpected losses impacting overall performance. Crafting effective capital structure strategies. Designing an effective capital structure involves assessing both quantitative metrics and qualitative factors influencing firm valuation. Key indicators include debt-to-equity ratios, cost of capital calculations, and weighted average cost of capital, WACC. A balanced mix between debt financing and equity issuance offers advantages such as tax shields from interest deductions and increased leverage for higher earnings per share, EPS. However, excessive reliance on borrowed funds can lead to insolvency risks during periods of declining revenue. Industry benchmarks provide useful reference points when comparing against peers operating under similar conditions. Companies within technology sectors may adopt different approaches compared to those in manufacturing due to varying asset requirements and growth trajectories. Dynamic adjustments must occur regularly as external environments evolve. Changes in monetary policy, inflation rates, or geopolitical events necessitate re-evaluating current financing arrangements promptly. Emerging trends suggest greater emphasis on sustainable financing models incorporating environmental social governance, ESG, criteria alongside traditional financial considerations. Investors now prioritize firms demonstrating responsible stewardship practices. Evaluating cost of capital components. Determining accurate component costs for calculating WACC remains critical in formulating sound financial strategies. The cost of debt typically reflects prevailing market interest rates adjusted for default risk premiums applicable to each entity. Equity financing carries inherent risks related to stock price volatility and expectations. Surrounding future dividends. Estimating expected returns often employs CAPM model parameters derived from historical data sets spanning several years. Preferred shares represent another layer requiring careful consideration since they offer fixed income streams but lack voting rights typical among common stockholders. Their inclusion affects overall capital composition significantly depending upon corporate goals. Accurate estimation methodologies ensure reliable projections guiding strategic initiatives aimed at enhancing organizational resilience amidst uncertain economic climates. Optimizing working capital efficiency. Efficient working capital management directly impacts daily operations' smooth functioning. Maintaining adequate levels of inventory, accounts receivable, and payable balances prevents cash flow shortages threatening continuity efforts. Inventory turnover ratios serve as vital diagnostic tools measuring how effectively businesses convert stored goods into sales revenues. High turnover indicates strong demand, whereas low values signal overstocking issues needing resolution. Accounts receivable days metric reveals average time taken before converting outstanding invoices into actual cash receipts. Reducing collection cycles improves liquidity positions, allowing better utilization of available funds elsewhere. Payables deferral period assesses duration granted by suppliers prior to settling obligations. Negotiating favorable terms enhances flexibility, managing incoming payments strategically aligned with outgoing disbursements. Technological advancements enable real-time monitoring systems tracking key performance indicators, continuously updating relevant stakeholders regarding current statuses vis-a-vis targets set forth annually. Advanced techniques in financial forecasting. Predictive analytics plays pivotal role shaping modern corporate finance functions through enhanced accuracy in anticipating future scenarios. Machine learning algorithms analyze vast datasets, identifying patterns previously undetectable via conventional methods alone. Sensitivity analyses help gauge vulnerability levels across diverse variables affecting bottom-line results. By simulating hypothetical situations involving fluctuating input prices or exchange rate variations, managers prepare contingency plans accordingly. Scenario modeling allows testing multiple outcomes simultaneously, considering interdependencies existing between different aspects comprising total enterprise value proposition. Such exercises foster proactive rather than reactive responses towards emerging challenges. Data visualization techniques transform raw numbers into comprehensible formats, facilitating quicker comprehension amongst cross-functional teams engaged in collaborative problem-solving activities. Integration platforms consolidate disparate information silos, ensuring seamless accessibility, promoting informed decision-making processes grounded upon holistic perspectives rather than fragmented views limited solely to individual departments. Mergers and acquisitions strategy development. Merger and acquisition activity continues being a significant driver behind industry consolidation, reshaping competitive dynamics, constantly evolving market space. Successful integrations require meticulous pre-acquisition due diligence procedures, verifying alignment between cultural norms and operational efficiencies post-merger event. Evaluation frameworks incorporate discounted cash flow models, estimating synergies achievable following transaction completion. Potential savings realized through economies scale justify premium valuations paid above intrinsic worths calculated independently. Risk assessment protocols identify hidden liabilities lurking beneath surface appearances presented during initial negotiation stages. Comprehensive audits uncover discrepancies which could derail otherwise promising deals once implemented fully. Post-merger integration planning commences concurrently alongside deal execution phases, focusing areas including IT system harmonization, human resource restructuring, brand identity management, etc., all integral components contributing toward successful transitions. Regulatory compliance checks remain imperative throughout entire M&A lifecycle, safeguarding entities against legal repercussions arising from non-adherence statutes governing cross-border transactions, particularly sensitive jurisdictions, imposing stringent disclosure mandates. Corporate governance frameworks and accountability mechanisms. Robust governance structures establish clear lines of authority, defining roles, responsibilities held by board members, executives alike, fostering transparency, accountability necessary. Healthy corporate ecosystems thriving sustained success. Board diversity initiatives promote broader representation encompassing gender, ethnic backgrounds, expertise domains, thereby enriching deliberation processes, leading superior quality resolutions crafted collectively, addressing multifaceted concerns confronting contemporary enterprises globally. Shareholder engagement programs cultivate stronger relationships, encouraging active participation, reviewing annual reports, attending meetings, providing feedback, shaping future directions, undertaking corporations pursuing long-term viability. Internal audit functions act as independent watchdogs, scrutinizing adherence, established controls, detecting irregularities early enough, rectify before escalating beyond manageable thresholds, potentially damaging reputational integrity. Whistleblower protections incentivize employees reporting unethical behaviors anonymously, protecting them from retaliatory actions, reinforcing ethical culture permeating every level hierarchy irrespective seniority status. Global Financial Reporting Standards compliance, adhering International Financial Reporting Standards, IFRS, Global Accounting Standards, GAAP, fundamental requirement ensuring consistency, clarity, communicated financial statements, prepared entities worldwide. Convergence efforts ongoing, harmonizing differences existing between IFRS GAAP, reducing complexity faced multinational corporations operating across borders, requiring dual reporting regimes, complying distinct regulations separately. Continuous education mandatory, keeping abreast updates issued, standards setting bodies implementing revised interpretations, correctly applying new guidance retroactively, prospectively whenever applicable circumstances arise. Technology solutions automate reconciliation tasks, streamlining conversion processes, transitioning local currency figures, converted international units accurately reflecting true underlying economic realities, captured original records, maintained source systems. Professional judgment exercised, interpreting ambiguous provisions, encountered practical application guidelines, provided regulators clarifications, sought whenever uncertainties persist, preventing erroneous disclosures, misleading users, relying. Published materials. Future trends shaping corporate finance practices, artificial intelligence revolutionizing financial services sector, automating routine tasks, improving efficiency, precision, executed operations, formerly reliant manual interventions, prone, errors, delays. Blockchain innovations enabling secure, transparent record-keeping, eliminating intermediaries traditionally involved, validating transactions, accelerating settlement speeds, minimizing fraud occurrences through immutable ledgers. Green finance gaining momentum, investors prioritizing ESG criteria, allocating capital towards environmentally conscious ventures, generating measurable positive impact, communities, planet, alongside attractive financial returns. Remote work paradigms altering traditional office setups, necessitating digital transformation strategies, supporting virtual collaboration tools, enhancing productivity despite geographical dispersal challenges inherently posed, decentralized workforce configurations. Quantum computing poised disrupt encryption methods currently securing financial databases, prompting renewed focus, cybersecurity protocols adapting novel threats. Likely emerge exponentially increasing computational power, harnessed malicious actors intent exploit vulnerabilities, exposed outdated infrastructures. Conclusion: strategic corporate finance planning serves as cornerstone ensuring organizational longevity, prosperity amid ever-changing financial landscape characterized uncertainty, rapid technological advancement, shifting consumer preferences. By integrating advanced analytical techniques, robust governance frameworks, compliant global standards, finance professionals empower organizations achieving sustainable growth, creating lasting value. Stakeholders invested shared vision, future development paths selected prudently, today's decisions